Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-Mini, the Mini Russell 2000, the crude oil and heating oil markets for Tuesday, January 10th. Starting off here with an intraday 4-hourly chart of the March E-Mini contract. We've had some very important price action overnight. You can see the markets break out above the past week's worth of resistance, generally around the 280 area. That confirms last week's 1260 low as the latest corrective low and the tightest risk parameter from which a bullish policy can continue to be endorsed and maintained. A failure below at least former now resistance turns support in the 1275 to 1280 area, and preferably the 1260 area is required to threaten this bull trend and expose a larger degree correction or reversal lower. Another very important part of this relatively short-term reaffirmation of this market's developing strength is the market's pressure on the key October 27th high at 1289, looking here at a daily log scale chart. Now, as fickle as this market has been, we want to be particularly watchful at the upper recesses of the past quarter's range for any kind of momentum failure that might warn of a larger degree correction or reversal lower. But in absolute fact, the market is on the verge of not only reaffirming the past month's broader bull trend, but arguably the major rally or recovery that dates back from that October 4th low way down at 1068. Moving here to a weekly log scale chart, you can see the market on the verge of breaking that October high at 1289. That would exposes a range virtually devoid of any pertinent technical levels of merit between that 1289 high and the May of 2011 high way up at 1373. We're not suggesting that this market's going to explode up to those highs or break those highs, but what it does do is, in fact, confirm the long-term trend as up, and it defines recent corrective lows. Again, last week's lows at 1260, and especially the 1243 corrective low from the last week of December from a longer-term perspective, that this market now would be required to fail below to defer or threaten a broader bullish count. And until or unless the market proves such weakness below at least 1260 and 1243, we don't know that by breaking this 1289 high from October 27th, this market might not run to the upside in a trendy, even accelerated way. These issues considered, a bullish policy remains advised, with weakness below 1260 and 1243 required to defer or threaten this view, and those are the levels, depending on one's personal risk profile, that one would want to manage the risk of a continued bullish play. Similarly, moving to the 4-hourly chart of the March Mini Russell contract, you can see the markets break overnight above last week's 75.90 high that we had defined as a short-term risk parameter following last week's short-term bearish divergence and momentum below the 73.60 area. By virtue of the market's recovery above 75.90, the market has negated that bearish divergence and momentum, and in fact has reinstated the broader bull trend that now leaves in its wake recent corrective lows at 74.32 as a tight risk parameter for shorter term traders with tighter risk profiles to protect a bullish position. And from a longer term perspective, the 73.26 corrective low from January 5th that is required to be broken to confirm a bearish divergence in momentum. Until the market proves weakness below at least 74.32 and preferably 73.26, at least the intermediate term trend is being reaffirmed as up, and you can see the market's position poised to take out that key 76.84 high from October 27th. That would confirm the long-term trend is up, and from looking here at a weekly log scale perspective, expose a run perhaps at the 2011 highs way up at 87.20. These issues considered, a bullish policy is again advised, with weakness below at least 74.32 and preferably 73.26 required to defer or threaten this bullish count. Given the positive correlation for the most part between the equity indices and the energy complex, it's not surprising to see a recovery in the February crude oil contract overnight that importantly defines yesterday's 100 spot 10 low and 61.8% retrace of the previous week's rally from 98.30 to 103.74 as the latest corrective low and a short-term risk parameter from which bullish policies and positions can continue to be maintained. The market has yet to break the 103.74 high from last week, but on the heels of the broader December rally, and from a broader daily perspective, following a clear three-wave and suspected corrective setback from November to December from 103.37 to 92.52. Arguably the long-term trend is up. A bullish policy remains advised. Now with weakness below yesterday's par spot 10, considered a short-term but objective risk parameter that we can protect the continuation of a bullish policy. From a long-term weekly perspective, the market is still wafting around the area of the 76.4% retrace of 2011's decline from 114.83 to 74.95 amidst extraordinarily high levels of bullish sentiment and arguably waning upside momentum, again on a broader weekly perspective. So we want to be particularly watchful for any kind of momentum failure that from the extreme upper recesses of the past year's range might expose a larger degree correction or reversal lower. But again, by virtue of something even as short term as overnight's recovery, we think the 100 spot 10 low from yesterday has been defined. The market has defined it as a tight but very objective risk parameter from which a continued bullish policy can continue to be based and maintained. Finally, and similarly, looking at the 4-hourly chart of the February heating oil contract, you can see overnight's recovery that's pressuring last week's 310.27 high. That probably means that the past week's merely lateral price action on the heels of the previous uptrend is merely corrective, consolidative within the context of this broader bull trend, and we expect to continue to new highs above 310.27. And most importantly, we think the byproduct of the past couple of days' recovery and the pressure on the upper end of this range is the definition of last Thursday's 303.39 low as the latest corrective low and tightest risk parameter. The market is now required to fail below to threaten this uptrend, expose it as a potentially complete five-wave Elliott wave sequence, and expose a larger degree correction or reversal lower. In lieu of weakness below at least 303.39, further and possibly accelerated gains remain anticipated. Moving to a daily chart, you can see the market's encroachment on the upper recesses of not only the past quarter's range, but indeed the past year's range, where again we want to be particularly watchful for any kind of shorter-term momentum failure that might expose a larger degree if intra-range relapse. You can see the 315.96 area is the 1.618 progression of late December's initial recovery from 277.71 up to 294.34 from that corrective low at 289.05. Again, we want to be particularly watchful of any momentum failure from the upper recesses of this range that would threaten this bullish bias. But for the time being, until this market can prove weakness below at least last Thursday's 303.39 low, further and possibly accelerated gains remain anticipated straight away. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.